Right now, while you're watching this, something massive is happening in the financial world that most people are completely missing. We're talking about over $100 trillion. It's going to move from one generation to another over the next 20 years. And here's what you need to understand. This isn't money that's just going to sit quietly in savings accounts. Okay. This is active capital that's looking for opportunities, looking for growth, looking for the next big thing. The real question isn't whether this transfer will happen. It's already happening. The real question is whether you're ready to position yourself to benefit from it. By the time we finish this conversation, you're going to know exactly where this enormous wave of money is headed. More importantly, you'll understand which stocks are sitting right in its path. But first, go ahead and hit the subscribe button. Here at Next Wave Investing, we cut through all the noise and complexity to give you clear, actionable insights. We're not interested in chasing whatever's trending on social media. We follow the money. And what I'm about to show you is something the big players on Wall Street have quietly known for months. Retail investors are only just starting to catch on. So let me set the stage for you. The baby boomer generation, the folks who built wealth through real estate, through traditional stock investments, through decades of compound growth. They control more than half of all the money in American households right now. That's an absolutely staggering amount of wealth. And right now, at this very moment, that wealth is starting to move. It's transferring to millennials, to Gen Z, to institutional investors who think completely differently about investing. Your parents' generation bought bonds. They bought dividend-paying stocks. They invested heavily in real estate. The younger generation approaching wealth today has entirely different priorities. And when we're talking about trillions of dollars suddenly moving in a new direction all at once, some sectors are going to explode. Others are going to get left in the dust. Now, here's another factor layering on top of this. Government policy is actively pushing for more domestic investment. We're seeing huge incentives for companies to build manufacturing facilities here in the United States, to develop infrastructure, to invest capital expenditure in American soil. Companies that are building physical things, creating real infrastructure, powering our digital economy. They're getting support from both private money and government policy at the same time. And then there's one more piece to this puzzle. Interest rates are likely heading down over the coming year as the economy normalizes. Why should you care about that? Because when interest rates fall, future earnings become more valuable in today's dollars. It's basic financial math. When rates drop, growth stocks tend to perform incredibly well. Small cap companies start outperforming. Businesses with expanding earnings get rewarded. We're looking at a perfect alignment of capital rotation, policy support, and monetary easing, all happening at once. But here's where most investors are getting it wrong. They think the AI opportunity is just about buying NVIDIA or other chip makers. Look, semiconductors had an incredible run, and it was absolutely massive. But that was the first wave. We're now entering the second wave, and this is where the real infrastructure opportunity begins. Think about it logically for a second. Artificial intelligence doesn't run on nothing. It needs massive compute power. It needs networking infrastructure. It needs enormous storage capacity, advanced memory systems, and perhaps most critically, it needs huge amounts of electricity. Data centers are becoming the factories of our century. Just like factories during the Industrial Revolution needed coal and steel and railroads, these digital factories need power, connectivity, and physical infrastructure. Let me walk you through the specific opportunities here, because this is where it gets really interesting. First, let's talk about computing power. You've heard all about GPU dominance in AI, but as artificial intelligence expands beyond just a few giant tech companies, alternative providers are gaining serious ground. Take a look at AMD. This company has deep exposure to data center growth. And the beautiful thing is, it's still trading at a discount compared to the market leader. Now, is there risk here? Of course there is. Competition is intense and execution matters tremendously. But if enterprise AI adoption keeps expanding, and everything we're seeing suggests it will. AMD is positioned to capture a meaningful chunk of that growth. They're not just selling chips. They're selling the computational backbone that powers cloud services and advanced AI models. Now, here's a sector that doesn't get nearly enough attention. This might actually be one of the biggest opportunities hiding right in front of everyone. Networking infrastructure. Most people never think about this. AI clusters need ultra-high-speed connectivity between thousands of graphics processors all working together simultaneously. When massive AI models are training on huge datasets, the bottleneck isn't always the chips themselves. It's how fast those chips can communicate with each other. This is where Arista Networks comes in. This company has become a dominant player in high-speed cloud networking. As AI clusters scale up, and they're scaling up incredibly fast, networking spending scales right along with them. Every major tech company building AI infrastructure needs what Arista provides. The risk here is pretty straightforward. Big tech companies slow down their infrastructure spending. Arista would fill it. But structurally, the demand trend is crystal clear. More AI means more networking infrastructure, period. All right, now we need to talk about something that might sound boring at first, but is actually one of the most critical pieces of this entire equation. Power, electricity, energy. I know it's not as exciting as talking about AI chips, but stick with me because this gets really serious. These AI data centers consume absolutely massive amounts of electricity. We're not talking about powering a few computers. We're talking about facilities that draw as much power as entire small cities, okay? And here's the fundamental problem. Our traditional power grid wasn't built for this level of demand. Solar and wind are great renewable options, but they're intermittent. You can't run a data center that needs power 24 hours a day, 7 days a week, on energy sources that depend on weather conditions. This is exactly why nuclear energy is making a serious comeback. It's the only scalable baseload power solution that can meet the long-term electricity demands of AI infrastructure. This brings us to Constellation Energy. This company is one of the largest nuclear operators in the United States. Major tech firms are already signing long-term power purchase agreements with them to lock in their electricity supply for the next decade and beyond. Are there risks? Absolutely. Energy pricing can be volatile and regulatory environments can shift. But the structural demand driving this is undeniable. If you believe AI is the future, and all the data suggests it absolutely is, then you have to believe that powering AI infrastructure is equally critical. Here's another angle most people aren't even considering: distributed power and backup systems. As the traditional power grid gets more strained, companies are exploring on-site generation solutions. Bloom Energy focuses on fuel cell technology that lets data centers and industrial facilities generate power right where they need it. This company is still in growth and scaling mode, so you need to watch their margin expansion carefully. But the underlying thesis is tied directly to infrastructure growth and concerns about grid reliability. Now, let's shift gears for a moment, because there's another major beneficiary of this wealth transfer that people are completely overlooking. It's the financial sector. I know banks aren't the most exciting topic, but hear me out. If the yield curve steepens, meaning the gap between short-term and long-term interest rates widens, and if capital markets activity picks back up, high-quality banks are positioned to capture serious gains. Look at JP Morgan. This isn't just any bank. They're investing heavily in AI technology for their own operations. They're maintaining an incredibly strong balance sheet, okay? And they're positioned to benefit from increased lending activity, higher trading volumes, and more investment banking fees, okay? As this capital rotation accelerates, they stand to win. The risk would be if overall credit conditions deteriorate. But historically, the best-in-class financial institutions often lead the market during economic normalization cycles. Here's something else you need to know. Small and mid-cap stocks have been absolutely crushed over the past couple of years as everyone piled into mega-cap tech. But historically, when interest rates decline and liquidity conditions improve. High-quality small caps tend to dramatically outperform after extended periods of underperformance. The key word here is selectivity. You can't just randomly buy any small cap stock. You need to focus on companies tied to infrastructure build-out, digital transformation, or industrial expansion. These are the businesses that could see disproportionate gains when capital starts flowing beyond just the mega cap names. Let me bring this all together for you, because this is the core insight. When massive wealth transfers accelerate, when corporate incentives favor investment over buybacks, and when monetary policy shifts toward easing, capital flows toward one thing: earnings growth. Not hype, not trends, not what's popular this week on social media. Actual, real, sustainable earnings growth. And right now, today, the physical backbone of AI and digital infrastructure is where that earnings acceleration is happening. We're watching it unfold in real time. Companies providing the compute, the networking, the power, and the financial infrastructure to support this transformation are reporting strong numbers and raising their guidance high. But let me be crystal clear about something. This is not me telling you to blindly buy everything I just mentioned. Valuation, discipline matters tremendously. Position sizing matters. Your personal time horizon and risk tolerance matter. What I'm giving you is a framework for understanding where structural capital flows are heading. This is about positioning yourself intelligently before this capital rotation becomes obvious to everyone else. Think about the investors who bought cloud infrastructure stocks 10 years ago when everyone thought the cloud was just a buzzword. Think about the people who invested in e-commerce logistics before everyone realized online shopping would dominate retail. Those weren't lucky guesses. They were smart investors who understood structural trends before the crowd caught on. That's exactly what's happening right now with AI infrastructure. The first inning was semiconductors. We're now in the second inning, which is the full stack build-out. Power, networking, compute diversity, financial infrastructure, and selective small caps positioned for this growth cycle. This is the opportunity right in front of us. Before we wrap up, I want to hear from you. Drop a comment below and tell me which sector you think is going to capture the next major wave of capital. Are you bullish on power infrastructure? Are you looking at networking plays? Are you betting on financial sector strength? Let me know your thoughts, because I read every single comment and your insights help shape future content here at Next Wave Investing. And if you found this breakdown valuable, here's what I need you to do. First, hit that like button. It genuinely helps more people discover this content. Second, subscribe to Next Wave Investing if you haven't already. We're building a community of intelligent investors who understand that real wealth comes from understanding structural trends, not chasing whatever's hot right now. And third, share this video. Send it to a friend who's interested in investing. Post it in your investing group. The more people who understand these capital flows, the better we all become at navigating markets. The next decade isn't going to reward random speculation. It's not going to reward people who buy whatever is trending. It's going to reward investors who took the time to understand where capital is actually flowing, who did their research, who positioned themselves intelligently, and who had the patience to let these trends play out. At Next Wave Investing, we focus on positioning before the crowd sees it. We do the deep work so you can make informed decisions. And we're just getting started. I'll see you in the next video, where we'll dive even deeper into specific stock analysis and market opportunities. Until then, stay focused, stay informed, and remember, fortune favors the prepared investor.